Yeah, great. I would like to talk about your investment strategy.
Yes.
And you have you say you want companies that are able to suffer and go
Yes.
through pain.
Yes.
And what does it mean?
Yes. Well, really, the ideal investment that I have over the years settled upon as one that offers my investors the most promise is a business that has the capacity to reinvest. Early lessons in value investing, primarily those given from Columbia Business School professor Ben Graham, focused on a margin of safety that was based on the discount between the market price and liquidating value, and that works really well so long as that the assets that you have are offset by a known number of liabilities. But over the years, the liabilities seem to have grown. They're social liabilities today. For example, when you try to close down a business, they involve employees, they involve the environment, and all sorts of governmental requirements upon dissolution, so that the business of buying and liquidating, which was the old-fashioned way of value investing, has become less relevant. It's also taxable, so anytime you do that, you have to pay taxes, and that's not very agreeable to my investors, who tend to be families, taxable families, and for them, they typically have made their fortunes from a business, owning a family business. And so they understand that those businesses can be very productive over time if they're fed properly and allowed to grow. Okay? And so if you think about old value investing, which was Ben Graham, assets less liabilities equals your intrinsic value, and if you buy at a discount from the intrinsic value and you liquidate the business, you can extract the difference and go back and reinvest it again and again and again, old-fashioned. The new value investing is, can you find a business with a very strong margin of safety in its competitive advantage that will allow the business to invest to grow going forward? But those businesses have to have something special. And what is often special in the world that I invest in are consumer brands. And so I look for businesses that have a portfolio of brands that can be invested into, either to expand into adjacent categories. If you're mainstream Budweiser, you can expand into Michelob or into another version and invest laterally, or you can expand into new geographies. And with the promise of that expansion, you have the ability to deploy capital internally, and that internal capital receives its own return, and going forward you can compound. And as Albert Einstein observed, compounding is the most powerful force in human nature. And so long as you have the ability to reinvest, you have the ability to compound. And so your margin of safety is, in fact, in the future appreciation that comes from reinvestment, rather than just the discount from liquidating value. The margin of safety is the competitive advantage, the brand that assures that when you make those dollars reinvestment, that they'll succeed. Now, not every company has the requisite portfolio of brands that are global. The reason global matters is because you have 95% of the world's population living away from the United States, and the fastest growing parts of that global population are in developing emerging markets. And those markets happen to be the place where GDP is growing. And so if we can find brands that can go into markets with a consumer preference, that are markets that are growing in population and disposable income, we have an ability to create the next layer of product preference, and that's very valuable. If you have the first mover in those markets, you secure something that's eternally valuable.
Which companies are very good with these emerging markets, and who's there, right? They are very active.
Well, the absolute mother of all companies in this particular arena would be Nestle. Mm-hmm. Nestle's been in 198 countries for 125 years. They serve 5,000 product servings per second around the world. I think it's like 1.7 billion products each day, and then if you reduce that to the per second, you're 5,000. The time that you and I have just spent talking, I think is 40,000 servings of one product or another of Nestle. Their products are both healthy and flavorful. They're beverages and food. There's developed markets and developing markets. It's a very balanced company, and they play for the long term. They are willing to invest against future returns, evidenced by the Nespresso business that they developed. It's a famous, dedicated, high-end premium coffee business built around a membership club. And it took 15 years of development before that product even broke even. That capacity to suffer through the reinvestment spending is something very few managements possess. Nestle management does, because of their unique Swiss heritage, where they build things for the long term right. That doesn't benefit most other companies. In other companies that we have large investments, typically the distinguishing variable is that they still are controlled by the founding families, because those families, with their control shares, so long as they have the proper long-term vision, give management the authority to reinvest, even when they have to suffer through the upfront burden on reported profits caused by such appropriate levels of long-term investment.
And that's what you like, a protective family, right?
Absolutely. So I end up having something like 60% of my assets in family-controlled companies.
Well, what is your favorite of those?
Boy, now that's an interesting question, because I can't choose amongst my children that way. That's the old expression.
Yeah, well, like a bunch.
But the big ones that I own, the largest would be Berkshire Hathaway, family-controlled company. Supreme example of the capacity to reinvest, because he's gone from 6,000. No, I'm sorry. Excuse me. He's taken his share price from $6 a share to 227,000. Now he only did that through reinvestments. He never paid out a dividend. As a shareholder, you've paid no taxes. You've only enjoyed the compounding of wealth internally. And the reason he's been able to strike so forcefully is that his best investments usually come at a time when others shy away because they don't want to have to suffer through the swings on reported earnings that are caused by the types of investments that Warren has joyfully plunged into making. And there's so many it's hard to refer to, but for example, when he bought Geico, they only had 1.5 million policyholders. Today they have 11 million. And between the time he purchased it and today, the one thing that you would have noticed living in America is how every television advertisement is for Geico. He has cavemen, he has lizards, he has Billie Jean King, he has all sorts of crazy things, telling people that they're foolish not to take Geico. And in fact, the business has grown by 9 million policyholders over this time. Why his predecessor didn't grow that was because the predecessor freestanding company, Geico, lacked the capacity to suffer. Because every time there's a new policy put on the books at Geico, in the first year of onboarding, Geico reports a $250 loss, year one. But the moment that they secure a new insured, on average, that insured will renew, and on average, they'll have very low combined ratio, and they'll pay enough so that they end up making $150 per year on average with their insured. So, but for the willingness to take upfront $250 in losses, reported losses, Geico, lacking that ability, grew slowly. Imagine at the time he bought it, there were 1.5 million policyholders, and he was making $150 a policyholder. That's $225 a year in profit, $225 million a year in profit. If Geico grew by 1 million policyholders the next year, they would go from reporting 225 million of earnings to 25 million of losses, because those new policyholders in the first year would overwhelm the reported income. Now, nobody can absorb that kind of suffering except Berkshire. Warren controls the shares. Inside Berkshire, he doesn't care a hoot about reported income. And every new policyholder that comes on the book at Berkshire is worth $2,000 lifetime value. So for the mere reported loss of $250 in the first year, Warren increases the net intrinsic value of his company by $2,000 per insured. Now he's added $9 million. So that basically means he's added close to $20 billion of value since he bought Geico by turning up the spending, suffering, current burden to deliver long-term wealth. That's what we look for. Berkshire's the class act in the field. That's the firm whose actions have taught me the value of this capacity to suffer. And the one thing that they aren't, however, is very international. They spent 5% of their money last year in foreign markets. Berkshire feels like there are 480 companies in the S&P 500 he still doesn't own. He has plenty to do here, generally. Our focus, besides Berkshire, and a couple of related local companies, mainly Wells Fargo and MasterCard, which both adopt the long-term view. The main holdings then become family-controlled foreign ones, whether it's Heineken or Pernod Ricard, which are both very, very large holdings, or Richemont, which owns Cartier, it's controlled by the Rupert family, or Swatch, which is controlled by the Hayek family, and they own the watch company Swatch, plus Omega and a variety of other jewelry companies like Harry Winston. Or with JCDecaux, the French billboard company. All of them have families firmly in control of the voter shares of the company. And so if they choose to invest for the long term, they don't have management who have to worry about losing their jobs or possibly forfeiting their company to disgruntled analysts on Wall Street or to activists. So those should be a handful. I think it's probably 7 names I just mentioned of companies that are all very important parts of our portfolio, and we oversee close to $12 billion in just this type of investments.
Your assets under management, $12 billion.
Yeah.
And how important for you is dividends? Because you mentioned Berkshire, they don't pay.
They don't pay dividends.
It doesn't really matter to you?
Dividends are entirely irrelevant to me. I would rather, so think about what Wall Street often cares about the wrong things and asks for the wrong things. And amongst most investors today, the one question that they want to have answered right is the cash flow conversion ratio. And that's the number from your earnings reported that you actually can distribute to investors. I would like to have the cash flow conversion ratios of our companies 0, because they have such compelling internal reinvestment that that they wouldn't think about doing anything other than redeploying capital internally to build competitive moat for the future. We're in it for the long term. Now, that's my general belief. However, we own a lot of tobacco companies. They actually pay out a huge percentage, as much as 85% of the reported income they pay out in dividends. I'm perfectly comfortable with that. There is always, as an investor in tobacco companies, the risk of confiscation, litigation, taxation, regulation, that leave you always somewhat with your eyes looking back over your shoulders as an investor in that industry. And for them to build mountains of cash internally in the company probably doesn't make sense. They're not going to be particularly useful vehicles for making acquisitions outside the tobacco industry because there's a tobacco taint that burdens companies in the tobacco industry. And if they go out and buy a food company or something else, they won't really create the value that they can by just focusing on deploying all of their investment funds that they can in innovation in the category, which our businesses are doing, and return the balance to the shareholders. And mind you, I mean, they can increasingly do ever less with their money. They can no longer advertise in many markets. They can't even have graphic packaging with trademarks because plain packaging is being bantered about. And so, you know, it really is an unusual business in my mix because they can't redeploy capital across many of their traditional efforts, and hence they throw back a lot of cash to the portfolio in the form of big dividends. But generally, my preference would be to redeploy capital, and Berkshire's the great example of where you can go if you direct your business cash flows back into furthering the business rather than shareholders.
What's your take on Google, Facebook, Amazon? There's also family behind.
Oh yeah, those are perfectly great. They're all of those are family-controlled companies with the capacity to suffer, capacity to reinvest. In fact, there is no business for whose shareholders have, in some ways, to suffer more burden on current income for the pursuit of transformative, great new platforms than Amazon. Amazon celebrates never really reporting profits, except for this new, what do they call it, web services, Amazon Web Services, which unfortunately for them just keeps gushing profits that they actually start to show profitability. Up until now, they almost never showed profitability because they're always plowing their base of small profits in pursuit of bigger opportunities. The people who, Sergey and Larry, when they founded Google, did so with very private shares that allow them permanently to control the company. And that permanent control means that they've been able to invest behind moonshots, and we've seen the outcome of those again and again and again in terms of the blockbuster businesses that they've been able to develop. And I think will continue to be able to develop because they can take the very longest term. Now, Google shares recently performed very, very well when they brought in a new person from Morgan Stanley to become the CFO. And that person started to talk about the exciting ways in which they're going to start to resource their divisions differently. I feared that was a euphemism for reining back some of the spending that has been permitted up until now by the capital structure controlled by a handful of founding partners. I would hope that by describing the efforts to rein in resourcing, that they don't actually use that as a euphemism for cutting back on adventuresome investments, because I think Google's had a good record of converting their investments into businesses that can be very monumental. Facebook I'm less familiar with, though I understand from anybody in the field that it may actually have one of the most robust platforms of all. But I don't have direct knowledge.
So you own Google and Amazon?
Neither.
Neither?
Neither. I haven't crossed over into the field of direct technology other than this small investment in JCDecaux, which is a user of technology to create out of home advertising. But the digital world still eludes me. I'm anxiously interested in finding a way to enter some of the investments. I haven't just found it yet.
What was the name again?
JCDecaux.
Deco.
You will see their billboards whenever you travel through an airport, because they have 14 of the world's 20 largest airports as clients.
Is it a French company?
It's a billboard company based in France.
In France.
Run by three brothers, one's based in England, one's based in North America, one's based in France. Family controlled the 70% of the shares, and they take the very long-term view when they bid on contracts for places like the Shanghai airport to invest more up front in return for a bigger share in the future than their competitors. And so they've been able to win successfully contract after contract, and they've developed a critical mass that makes it very hard for others to breach because of the amount of embedded knowledge that JCDecaux develops over time in what their advertisers most need and care for.
Do they also do online advertisement, or?
They don't. I mean, they are out of home. They do billboards. They do display panels at bus stops. They create that bike rental product that you see in New York with those city bikes. That's their program.
Mm-hmm.
They buy the bikes, and then they rent out that local to the city, and then they organize the infrastructure with all the trucks that rebalance the location of the bikes at the end of each day, and register the payment for the use of those bikes. And then as those bikes scurry around town, everyone who sees one sees Citibank, and they're reminded that they should go to their local Citibank and open up a new account. That's the theory behind that out-of-home advertising.
Yeah. And you are not worried that people would say, "Oh, it's old-fashioned"? Has it a future?
There's nothing more fashionable in terms of its prevalence today than traffic jams in emerging markets. And so long as you have traffic jams in emerging markets, you'll have people who will look out their window and see billboards. And so as long as they have traffic jams in emerging markets, I think we'll be comfortable in knowing that the human eye will likely look at billboards when they wait for the cars to begin to move again. The one area of technology that's terribly important to JCDecaux's business is the technology to take those billboards and turn them into digital billboards, so that as you're sitting there, instead of seeing one billboard, you'll see 6 times a repeated message, and that message can be updated to be day part appropriate. So if it's in the morning, you'll see 6 commercials for coffee, and if it's in the evening, 6 commercials for beer or hot dogs. And so they can create more specific and tailored appeal.
Mm-hmm. Do they also do a Times Square? Do they own?
Oh yeah,
some? Yeah.
I mean, and one of their largest advertisers today, the 2 largest advertisers, are Apple and Google.
Okay.
And they have the largest screen of any indoor screen anywhere in Waterloo Station in England, in London. And it was the activation of a 360-degree campaign that JCDecaux did for Jurassic Park 2 that created the best-selling results. The producers of the movie, the distributors of the movies, use out-of-home advertising in England to activate it.
Mm-hmm. And what is your holding period? You said you want it for the long run.
Yeah.
And so your holding period is like Warren Buffett, the best is forever?
That's right.
Mm-hmm.
And actually, it's been forever for most of my holdings. I mean, I've held Heineken since 1986. I've held Nestle since 1986. I've held Philip Morris since 1990. I've held Wells Fargo probably since 1994. I mean, I take to heart one of Warren Buffett's recommendations, which is, as an investor, your goal is to be right once. And if you find a business that has the capacity to reinvest, they have the cash flow from mature markets to deploy and reinvesting, they have the culture of investing for the long term at the cost of the near term. Let's say they have multilingual managements, they have multicultural management, so they understand the nuances of marketing in the rest of the world. And they have brands that have been existent in the rest of the world but not yet activated because the consumer couldn't afford them. The products became aspirational as a result, and so they can charge a good price to satisfy the aspiration of the emerging market consumer. That is the sort of model. I think this notion of being right once, though, is kind of at the heart of what we've watched Mr. Buffett do so successfully over time. There's another. So if you're